As the week comes to a close, we're once again made aware of a striking and unsettling reality in 22 that hadn't been there for so many years in the aftermath of the financial market way through 2021. That reality is the reality of a disconnect between monetary policy at the Fed versus monetary policy at the other major central banks. The Fed has continued to push forward with a higher for longer policy track in an effort to combat inflation, while the other central banks have been unable to be as aggressive with monetary policy tightenings on account of serious worry about the impact on growth. This has resulted in both downside pressure on global risk assets and a strong wave of demand for the US dollar. This trend was once again highlighted and reaffirmed this week, and we suspect things will continue to lean this way for the foreseeable future. At the moment, a lot of the market's focus will be on the upcoming economic data out of the US, namely today's jobs report and then inflation data around the corner. The market will be wanting to see signs the Fed needs to reconsider its policy stance and lighten up on the gas. And these signs will have to come by way of a weaker jobs report and softening inflation data. If we don't get this, and if things move the other way, it could really intensify the trends of lower stocks and a higher dollar into the end of the year. Key standouts on today's calendar come from German factory orders, an ECB Lagarde speech, Eurozone services PMI reads, UK construction PMI reads, Eurozone producer prices, the Canada jobs report, the US jobs report already mentioned, and Canada IV PMIs. That's all for